It's an era of multinational companies, companies operating across geographical boundaries, companies operating all over the globe. So when you look at a company like Walmart, the parent, that's in the US, but they've got subsidiaries all over the world. So they got subsidiaries in Canada, they've got subsidiaries in 12 countries in Africa, Argentina, Brazil, 5 countries in Central America, Chile, China, India, Japan, Mexico, and the United Kingdom. Now guys, that's all so good, so amazing. But now from an accounting perspective, think about it. All those subsidiaries are maintaining their records in their local currencies. So you have the Canadian subsidiary that's maintaining its records in Canadian dollars. The Mexican subsidiary that's using Mexican peso. UK subsidiary that's using pounds. Indian subsidiary that's using the Indian rupee to keep its books of records. Now, when all the subsidiaries get consolidated into the US parent, we need to convert from the local currency unit, from the local transactional currency to US dollars, which is the reporting currency for the US parent, Walmart stores. So guys, now we want to find out how do we get from that transactional currency, the local currency units, to US dollars reporting unit. And that's what we're going to discuss right now. So we're looking at related companies. Let's put it as foreign subsidiary. And we want to know how do we move from transactional currency to the reporting currency. The transactional currency, let me put it as local currency unit. So this would be Canadian dollars or Mexican peso or the UK pounds or the Indian rupee. Reporting currency, if it's a US parent, the reporting currency is going to be US dollars. So this is the currency of the parent where the consolidated financials are reported in this reporting currency. Now, when you want to get from transactional currency to reporting currency, the first question that you want to ask is, what's the functional currency of the subsidiary? So guys, we already know the transactional currency of the subsidiary, that's the local currency unit. Now we're talking about functional currency. So transactional currency is the currency in which the foreign subsidiary maintains its books of records. Functional currency is the currency that has the highest economic impact on the foreign subsidiary. Primarily, it's the currency in which the foreign subsidiary generates and receives cash. Now, this functional currency, this could be the local currency unit. Yes, it could be. It could also be the US dollar. And that's your question mark here. Is the functional currency this local currency unit or is it the US dollar? And that would determine the route that you're going to take to convert from transactional currency to reporting currency. So that's your target. You're going to move from the recording currency to the reporting currency. How do we do that? That depends on what's the functional currency, because I'm going to give you two methods, two routes of doing that. So one route is from here to here. This is called remeasurement. The second route is from here to here, and that's called translation. So let us say we are looking at Walmart's Indian subsidiary. What's the transactional currency for the Indian subsidiary? That's the Indian rupee. So they do all the transactions in Indian rupee. Functional currency. What's the currency that has the largest economic impact on the Indian subsidiary? Now, the Indian subsidiary is buying most of its goods from local Indian vendors. And it's selling nearly all of its goods in India. So the currency that has the largest, the greatest economic impact on the Indian subsidiary is also the rupee. So guys, this and this is the same. So we don't need this. We don't need to remeasure. Transactional currency and functional currency, that's the same. But when the financials of the Indian subsidiary are to be consolidated with the US parent, where the reporting currency is US dollars, that's when you have to move from rupee to US dollars. How do you do that? Translation. So guys, in this case, we didn't do remeasurement because the transaction currency and the functional currency, they were the same. But we did translation because we wanted to move from rupee to US dollars. So this was the route that we had to take. Give you another example here. Let's say we're talking about Ford Motors. They got a manufacturing plant in India. So the transactional currency for the Ford's Indian subsidiary, that's Indian rupee, naturally. Now the manufacturing plant in India sources most of its raw materials from within the country, sells most of its cars within India. So what's the currency that has the greatest economic impact on Ford's Indian subsidiary? Rupee, not dollar, rupee, local currency unit. So guys, transactional currency and functional currency are the same. So we don't need remeasurement. We would translate from functional currency, that's the Indian rupee, to the reporting currency, US dollars, when the Indian subsidiary gets consolidated with Ford Motors' US parent. Now, let's go on. I'll give you more examples here. Let us say we are talking about a US parent which has a shell subsidiary in a tax haven, where the purpose is to avoid taxes. Guys, I said avoid taxes, not evade taxes. So let's say that tax shell subsidiary is in Bermuda, and in Bermuda, they're maintaining the records in Bermudian dollars. What's the functional currency for that shell subsidiary? I mean, the shell subsidiary is just a small office where you have a few people working. Nothing happens there. So the functional currency of that shell subsidiary is US dollars. Reporting currency for the US parent, that's also US dollars. So guys, here, when we had the same transactional and the functional currency, I said, here it's the same. So you need to take this route. You need to translate to get from functional currency to reporting currency. Now it's a different scenario. Now I'm telling you that the functional currency and the reporting currency, they're the same. You're going to move from transactional currency to the functional currency and you would remeasure. So I've sort of given you two routes. And in most cases, you got to take one of the two routes. So when we're looking at the same transactional currency and functional currency, that means both of them are the local currency unit, no remeasurement, the red pen, only translation. When we are looking at the same functional currency and reporting currency, the green pen, that's when you got to remeasure to move from the transactional currency, which is in the local currency unit, to the functional currency, a different functional currency here. To give you more examples of remeasurement, let's say we're looking at a US parent which has got a captive BPO in a foreign country. Now, the BPO derives all of its revenues. It's totally dependent on the US parent. So, the transactional currency would be the local currency. But the functional currency could be maybe the US dollars. Reporting currency, naturally US parent, US dollars. So in that case, the captive BPO's financials may need to be remeasured to get converted to US dollars. Functional currency in this case. A better example, let's say we are looking at a US parent which has got a sales office in India. And even the sales amounts in India are determined by the foreign exchange rates. So let's say the Indian branch is selling a product which is $10,000. Now what they say is if $1 equals 50 rupees, we would charge 500,000 rupees for the $10,000 product. But if rupee weakens, if $1 becomes 55 rupees, then we're going to charge more. We're going to charge you 550,000 rupees. So guys, in this case, we are looking at the Indian subsidiary, Indian sales office. Transactional currency, that's rupee. Functional currency, they're not doing anything in India. The goods are coming from the US. And even in India, they're selling at US prices, just that they're taking it in rupees. The functional currency, the currency that has the largest economic impact in this case, is not rupee, it's the dollars. Because the pricing depends on the dollars. Reporting currency, US parent, so it's going to be US dollars. So in this case, this and this is the same. They would simply need to remeasure to move from Indian rupee to US dollars. Green pen again. Okay, now let me try to build it up. Let me try to add more surprise, more suspense out here. Let's say we're talking about Ford Motors again. They got a manufacturing plant in India. I said the transaction currency is rupee. The functional currency for the India plant, that's also rupee. They're producing, the manufacturing the cars in India, selling it off in India. Reporting currency is US dollars, so they translate. Let's say the Indian subsidiary of Ford Motors has a sales office in Sri Lanka, a subsidiary in Sri Lanka. Now the Sri Lankan subsidiary, the transaction currency for the Sri Lankan subsidiary, that's going to be Sri Lankan rupee. But the Sri Lankan subsidiary doesn't do anything. They just take the cars from India, sell it off there at whatever the exchange rate is there between the Indian rupee and the Sri Lankan rupee. So when we are looking at the Sri Lankan subsidiary, the transactional currency is Sri Lankan rupee. The functional currency is Indian rupee. And the reporting currency, that's US dollars. So now we have a different transactional currency, a different functional currency, a different reporting currency. Once again, the Sri Lankan subsidiary, their transactional currency, they maintain the books of records in Sri Lankan rupee. But they don't have any manufacturing going on in Sri Lanka. The cars simply go in from India, and whatever is the exchange rate between India and Sri Lankan rupees, that's the price that they charge in Sri Lanka. So the Sri Lankan subsidiary has a transactional currency, Sri Lankan rupee. The currency that has the greatest economic impact on the Sri Lankan subsidiary, that's Indian rupee, a different LCU. And the reporting US parent, US dollars. So in that case, you would first need to remeasure from the Sri Lankan rupee to the Indian rupee, this route. Then you would need to translate from Indian rupee to US dollars. So guys, I know it's all fun and exciting stuff. Let's look at all of this on your book. On page 27, we're looking at foreign currency accounting for related company or foreign subsidiary. Here we're looking at highlight transactional currency and write LCU. This is the local currency unit of the foreign country. It's the recording currency in which the foreign subsidiary keeps its books and records. Then we have highlight functional currency. Now this is the currency which has the greatest economic impact on the foreign subsidiary. So it could be a local currency unit or US dollar. And then we have highlight reporting currency. This is the currency in which the parent prepares its financial statements. Generally on the CPA exams, it's US dollar. Now, if the transactional currency and the functional currency are different, in that case, we need to go for put a box around remeasurement. If the functional currency and the reporting currency are different, we need to go for put a box around translation. Turn to page 28, and on the first half of this page, we got an amazing analysis of when to do remeasurement versus when to do translation. So if the foreign operations or the foreign subsidiary is highly integrated with parent and the day-to-day operations are based in US dollars, that means the functional currency is also US dollars, or highlight functional currency equals reporting currency. In that case, we need to go for highlight remeasurement. Now this is also applicable in cases where there is underlying over 100% inflation in foreign country. Now, if the foreign subsidiary is self-contained and independent and day-to-day operations of the foreign subsidiary are based on the local currency unit, that means highlight transactional currency equals functional currency. In such cases, we need to go for highlight translation. Next, if the foreign subsidiary which is self-contained and independent is operating in another foreign country with a different local currency unit, that means highlight all three currencies are different. First, we need to go for highlight remeasurement, and then we need to go for highlight translation. Now we look at a comprehensive example where we'll start with the financial statements of the foreign subsidiary which have been prepared in its transactional currency in the local currency unit of the foreign subsidiary. So you got the income statement, retained earnings, balance sheet, all the numbers here are in the local currency unit. And these are numbers that have been picked up from the example that you have on your book. So if you look at the income statement, you have sales 630,000 local currency unit. Then you have less COGS, less depreciation. Now on our income statement, we never had depreciation separately because depreciation was included within COGS and within SG&A. So if it was depreciation of factory equipment, that was COGS. Depreciation of office equipment, administrative block, G&A. Depreciation of delivery trucks, selling. But now for the purposes of remeasurement, we look at that, we would need to have depreciation as a separate number taken out of COGS and SG&A. So you got COGS 480,000 local currency unit, depreciation 26,400 local currency unit, SG&A 50,400 local currency unit. That gives you operating income of 73,200 local currency unit. Then you have no non-operating item, taxes are 22,800 local currency unit. That gives you income from continuing operations 50,400 local currency unit. Now we don't have discontinued or extraordinary here, so the net income is also 50,400. Now on the book, the example says the company started this year, so there's no beginning retained earnings, they've paid out no dividends, so it's just the net income 50,400 local currency unit, that's your ending retained earnings. Then they got assets, they got cash, receivables, inventory, they got PP&E, they got liabilities, accounts payable and debt, stockholders equity, they got common stock, and this retained earnings number 50,400 local currency unit. So all these have been prepared in the foreign subsidiaries local currency unit, but they need to be consolidated with the parent, the US parent, and need to be converted to US dollars, the reporting currency. Now as I told you, there are two routes of doing it. If the functional currency is the US dollar, if US dollar is the currency that has the greatest economic impact on the foreign subsidiary, then you would remeasure. Now, if the functional currency is the local currency unit, so if the local currency unit is the currency that has the greatest economic impact on the foreign subsidiary, then it's the same transactional and functional currency. You need to translate to get to the reporting currency, US dollars. So what we'll do is we'll first start with translation and then look at remeasurement. So let's first read the example. So we have the foreign exchange rates from there. So you got financial statements of a foreign subsidiary remeasured versus translated. So we're going to do both with these numbers, remeasurement as well as translation. So depending on what's the functional currency, you need to decide whether you need this remeasurement or translation. If your functional currency is US dollars, you would remeasure. If the functional currency is the local currency unit, then you would translate. So it's either one of the two, but on our example, we'll show both so that you can compare and contrast. So it says the assumptions are: number one, the parent company organized the subsidiary on 31st December 2009. The exchange rates for the local currency unit, and that's very important when you're moving from the local currency unit to US dollar. We need the exchange rates. It says the historical exchange rate on 31st December 2009, the day the subsidiary was organized, is 0.17. Now the current rate at year end on 31st December 2010 is 0.11, and the weighted average exchange rate during the year is 0.14. So let me put it like this. So we could say we are looking at what is one local currency unit equal to. And we are talking about three exchange rates. We are talking about the weighted average rate during the year. We are looking at the historical rate, and we are looking at the year-end rate. This is the balance sheet date. So now that's the Y. So W, the weighted average rate is 0.14. So the weighted average rate is 0.14. So one local currency unit is 0.14 or 14 cents. Historically, one local currency unit was 17 cents. And at year end, one local currency is 11 cents. Yes, historically, the local currency unit was equal to 17 cents. Then it depreciated. During the year, it was just 14 cents. End of year, it was just 11 cents. So, this trend looks like the local currency unit has been depreciating when compared to the US dollar. Then you have inventory was acquired throughout the year and sales were made evenly throughout the year. You got fixed assets were acquired by the subsidiary on 31st December 2009. So this was the 31st December 2009 rate. This is the 31st December 2010, the balance sheet date. And this one is during 2010. Now, what we would do is, okay, so ignore the tax effects. So we'll just forget about taxes for now. And we're looking at remeasurement versus translation. And as I said, first we'll do translation. Now, when we start with translation, we first going to look at the income statement. Then we would go to the balance sheet. So guys, remember, whenever we are doing translation, our direction of movement is from the income statement to the balance sheet. So on the income statement, we're going to use weighted average exchange rate, because income statement is during the year, right? Sales have happened during the year. COGS, the goods have been purchased during the year. SG&A during the year. So for the income statement, we're going to use the weighted average exchange rate. So now if we use this weighted average rate of 14 cents for all these numbers, we can translate the local currency unit numbers to dollar numbers here. So looking at the numbers here, 630,000 local currency unit into 14 cents, that gives me $88,200. Let me use the black pen for this. Now, 480,000 local currency unit into 14 cents gives me $67,200. When I'm looking at depreciation, 26,400 local currency units into 14 cents weighted average rate gives me 3696. SG&A, 50,400 local currency unit into 14 cents weighted average rate gives me 7,056 out here. That's operating income of 10,248. Guys, this was all local currency unit. Here we are looking at all dollars. So this is $88,200. This is $10,248. Income tax expense, 22,800 local currency unit multiplied by 14 cents gives us 3,192. So the net income here is $7,056. Now we said beginning retained earnings is 0, so that'll be 0 here. Net income, so it was 50,400 local currency unit which came down here. Here we are going to have the 7,056 net income in dollars coming down. So it's $7056. There's no dividends during the year. So the ending retained earnings is also 7056. So as you can understand, we have moved from here to here. So net income on your income statement flows into the retained earnings statement. Then you have ending retained earnings 7056. This would flow into your balance sheet. So you'll have 7056 here. So this is the direction that it's flowing. I told you, right? We're moving from the income statement towards the balance sheet. And that's how you're doing it. Now, for the income statement items, we used the weighted average exchange rate. For the balance sheet items, what we would do is for assets and for liabilities, we would use the year-end exchange rate. That's the Y as of the balance sheet date. So for assets, it's Y, year-end rate. For liabilities, also it's Y, the year-end rate. Under equity, for common stock, we're going to use historical rate. The common stock was issued, so that's H. Retained earnings, it flows through. So there's no rate here. So for assets and liabilities, we're going to use the year-end exchange rate. So we're going to multiply all these numbers for assets and for liabilities into 11 cents each, the year-end rate. Guys, for income statement, you used the weighted average exchange rate. For balance sheet, for assets and for liabilities, we're going to use the year-end rate. For common stock and APIC, we're going to use the historical rate. So these are stuff that you need to remember, be comfortable with. Think about the income statement during the year. Balance sheet, that's as of year-end. Now putting in the numbers in place. So cash is how much? 12,000 local currency unit multiplied by 11 cents gives me 1320. Accounts receivable, that's 60,000 local currency unit multiplied by 11 cents gives me 6,600. Inventory, that's 114,000 local currency unit multiplied by 11 cents gives me 12,540. PP&E, fixed assets, that's 330,000 local currency unit multiplied by 11 cents, because guys, we are looking at the year-end exchange rate, right? So 11 cents gives us 36,300. Their net of accumulated depreciation, 26,400 local currency unit multiplied by 11 cents. That gives us 2904 contra asset. So all the assets in total are $53,856 on these translated balance sheet. Guys, we're doing translation here. So this number here is 53,856. We're looking at dollars and dollars here. Now looking at liabilities. So the liability here is accounts payable 40,800 local currency unit, again multiplied by the year end exchange rate 11 cents gives us 4,488. Debt of 158,400 local currency units multiplied by 11 cents gives us 17,424. That's total liabilities of 21,912. Now looking at common stock. Now common stock 240,000 local currency units. This one I told you would be at historical rate. So this subsidiary was organized on 31st December 2009. The exchange rate historically back then was 17 cents. So we're going to multiply 240,000 local currency unit into 17 cents historical rate. Common stock, I've written H here. So that gets us 40,800. Now let's do this 40,000 under equity. You got 40,800 of common stock, retained earnings of 7,056 gives you 47,856. So guys, if you look at it, we have successfully translated the income statement and the balance sheet. Now, let me just look if everything is fine here. I got assets of $53,856. What's my liabilities plus equity? My liabilities, that's 21,912. And my equity, that's 47,856. This comes to 69,768. Guys, the basic rule that we learned in accounting, assets should be equal to liabilities plus equity, but something's wrong here. Assets are not equal to liabilities plus equity. Guys, this is wrong because we've used different exchange rates for translation. We've used the weighted average rate here. On the balance sheet, we've used the year-end rate for assets and liabilities, historical for common stock. And that's the reason for this difference between assets and liabilities plus equity. And to plug this difference, to make sure assets equals liabilities plus equity, we're going to have a plug on our balance sheet. And this plug, we would call it accumulated OCI. Guys, if you recall, we said OCI, accumulated OCI, that's PACE, P-A-C-E. And the C of the PACE, that was currency translation. So guys, what we are saying is the assets is not equal to liabilities plus equity. We got to plug a number for accumulated OCI such that asset becomes equal to liabilities plus equity. So if we have a negative number for accumulated OCI, 15,912, then the total of equity would become, so let's do it. So common stock would be 40,800, retained earnings of 7,056, and accumulated OCI negative 15,912. So that's like a loss there. This is 31,944. So let me change this number now. Now liabilities plus equity. So 31,944 of equity plus 21,912 of liabilities. Yeah, now this is cool. Now that's equal to 53,856. So guys, as you realize, we had to have a balance sheet plug here. Now, since it's negative, you could say it's a loss from currency translation. So now, when these numbers get consolidated with the parent, you would say the parent had a loss from translation of foreign currency, from translation of its foreign subsidiary. So guys, quick recap on translation. Number one, so let's get to the dashboard. You're going to use translation when the transaction currency and functional currency are the same generally. And the functional currency needs to be converted to US dollars. So you have a different functional currency and reporting currency. So you translate to move it from the local currency unit, the functional currency, to the reporting currency, US dollars. So generally you would translate if your functional currency is the local currency unit. The second thing, whenever you are translating, you are moving from the income statement to the balance sheet. So that's how we move. So we move from income statement to the balance sheet. Third thing, whenever you're translating on your income statement, you're going to use the weighted average exchange rate during the year. On your balance sheet, you would use the year-end exchange rate for assets and for liabilities. For stockholders' equity, common stock, APEC, you're going to use the historical rate. And because there would be a disparity between your assets and liabilities and equity side, you're going to have a plug, and that plug is called accumulated OCI. So for translation, you got a balance sheet plug because you're moving from income statement to the balance sheet because you want to find this balance sheet plug. On page 30, we're looking at the steps for translation. Highlight translation, income statement to balance sheet. So whenever we're doing currency translation, our direction is from the income statement to the balance sheet. Look at the translation approach towards the bottom of the page. So you got the income statement where we translate income statement items using the weighted average exchange rate. So highlight at W. The net income from the income statement that flows into the retained earnings statement. Then you have ending retained earnings which flows into the balance sheet. Now on the balance sheet, the assets and liabilities are translated using the year-end exchange rate. So highlight at Y for assets and at Y for liabilities. Now for equity, contributed capital, common stock and APEC, we're going to use highlight at H, historical exchange rate. And the plug here is accumulated OCI. That's the C of the pace. That's the gain or loss on currency translation. Let's look at the example that we have on page 32. So here we have the parent company organizing the subsidiary on 31st December 09. You have exchange rates for the LCU were as follows. So the exchange rates for the LCU, we're talking about what is one LCU equal to in terms of dollars. So right there, one LCU equals, so the historical exchange rate was 17 cents. So one local currency was 17 cents, right? H there. The current rate as of 31st December 2010, that's 11 cents. So write Y there. The weighted average exchange rate during 2010 is 14 cents, right? W. Because end of last year, one local currency unit was worth 17 cents. During the year, it was worth 14 cents. At the end of the year, it was only worth 11 cents. Now, this shows that the local currency unit has actually depreciated. Now, that's a quick analysis that I've done. So, right there, LCU depreciated. Now this is not so relevant for the problem, but write FYI only. This is only for your information. Now to get more comfortable with this foreign exchange rates, let's look at what's $1 equal to. So historically, 1 LCU was equal to 17 cents. So you could write there $1 equals 6 LCU. Now at year end, 1 LCU was equal to 11 cents. Or you could say, right, $1 equals 9 LCU. During 2010, 1 LCU was equal to 14 cents. Or you could say, right, $1 equals 7 LCU. Then you have inventory was acquired evenly throughout the year and sales were made evenly throughout the year. That's during 2010. So we're going to write use W. Fixed assets were acquired by the subsidiary on 31st December 09. So here we're going to write use H. Now we got the financial statements of the subsidiary in its local currency unit. So underline LCU. And we're first looking at highlight translation. So we're going to translate the local currency units to underline dollars and put a dollar sign there. For translating income statement items, we're going to use the weighted average rate of 14 cents. So put a box around all those weighted average exchange rates and write W. This gets us to net income of $7,056, which flows into the statement of retained earnings. And then the ending retained earnings, that flows into the equity section of the balance sheet. Now looking at the balance sheet, for assets and liabilities, we're going to use the year-end exchange rate of 11 cents. So put a box around all those year-end exchange rates and write Y. For common stock, we're going to use the historical exchange rate of 11 cents. So write H there. Now the assets section and the liabilities and equity section of the balance sheet do not match. To match them, we have a plug under stockholders equity called accumulated OCI. So highlight plug, and that is a negative 15,912. So this is a loss on foreign currency translation of $15,912. So guys, we can see that for translation, we are moving from income statement to balance sheet. Gain or loss in balance sheet. So the gain or loss on translation, that gets parked in accumulated OCI, and PACE, circle the C, because the C of PACE is currency translation gains and losses. I'm sure you've gotten very comfortable with when to do remeasurement versus when to do translation. So let me knock this Bermudan dollars off. So I just have rupee, the Indian rupee, and the US dollars. So if the functional currency is the local currency unit, then we need to translate to get to US dollars on these financials, reporting currency. If the functional currency itself is US dollars, we'll reach US dollars when we remeasure. So guys, you decide whether to use remeasurement or translation when you know your functional currency. Is it a local currency unit or a US dollar? Now, if you have two different local currency units here, so let's say if you have Sri Lankan rupee here, Indian rupee here, US dollars here, then first you need to remeasure from Sri Lankan rupee to Indian rupee, then translate from Indian rupee to US dollars. But now we are looking at either remeasurement or translation. So we got an example here where we've already looked at translation So when we were translating from the local currency unit to US dollars, our direction of movement was income statement to the balance sheet. Because the plug, the gain or loss from this currency translation went into accumulated OCI, did not go onto your income statement. But when we're doing remeasurement, in that case, our direction of movement would be from the balance sheet to the income statement. Because the gains and losses on currency remeasurement are going to go to your income statement, non-operating gain or loss here. The gain or loss on translation went into accumulated OCI on the balance sheet. That's why we moved from income statement to the balance sheet. The gain or loss on remeasurement would be on your income statement. So we're going to go from the balance sheet to your income statement. So guys, it's simply a reverse direction. And the reasoning, our plug, the non-operating gain or loss on remeasurement is going to be on the income statement. So let's look at the example, build it up further. So you got the same numbers. Now we're not translating, we are remeasuring. We would remeasure if the functional currency is also the US dollar. Only in that case, we're going to remeasure and we're going to make our remeasurement gains and losses go into the income statement. So we're going to start with the balance sheet and then go on to the income statement. Now, when you're doing remeasurement on your balance sheet, you first need to divide the items into monetary items and non-monetary items. Guys, in translation, there was no monetary, non-monetary. All your assets, all your liabilities were at the year-end exchange rate. Now, in case of remeasurement, on your balance sheet, first you need to look at whether the assets and liabilities are monetary or non-monetary. Because if it's monetary, monetary means fixed dollars. So that's like cash, debt, bonds payable. So that's year-end exchange rate. But if it's non-monetary, not fixed dollars like inventory, PP&E, you're going to use the historical rate. So let's say if it's land, if it's equipment, non-monetary, not fixed dollars, move up and down with inflation, market appreciation, that's historical dollars. If it's fixed dollars like cash, currency, receivables, year-end exchange rate. Here we used year-end exchange rate for all assets and liabilities, whether or not they were monetary or non-monetary. Here we are dividing the assets and liabilities into monetary and non-monetary. For monetary, fixed dollars, use year-end rate. For non-monetary, not fixed dollar, use the historical rate when you bought it. Now, something like inventory, you might want to use the weighted average rate during the year, because inventory might not have been bought ages back. It might have been bought during the year. And on this problem, we have inventory was acquired evenly throughout the year. So though inventory is a non-monetary asset, instead of taking the historical rate, we'll take the weighted average rate during the year. So that was when the inventory was purchased. So guys, let's start doing it and you'll get very comfortable with this. So we're looking at monetary versus non-monetary assets and liabilities. So cash, that's monetary. So monetary means we're going to use the year-end exchange rate. So 12,000 local currency unit into 11 cents gives us $1320. Accounts receivable, that's monetary. Monetary means year-end exchange rate, 60,000 local currency unit into 11 cents year-end rate. That gives us $6,600. Inventory, 114,000 local currency unit. Now inventory is a non-monetary asset. We got to use the historical rate for that. But it says inventory had been purchased during the year. So we'll use the weighted average rate, 14 cents for that. So that gives us 15,960 for inventory. Look, these numbers are different for inventory here. Because here we had used the year-end exchange rate. Here we've used the weighted average rate for inventory. Now big difference would be for PP&E. So PP&E non-monetary. and they were all purchased on 31st December 2009. So we're going to use 17 cents historical rate. 330,000 into 17 cents, and that gives us 56,100 for PP&E, and the accumulated depreciation 26,400 into 17 cents historical rate gives us 4,488. Guys, look at the difference in the balance sheets here. For cash and receivables, there's no difference. We've used year-end rates here and here. So this is at year-end rate. So I would say, rather, both these are at year-end rate. So this is same result. For inventory, here we use the year-end rate. Here we've used historical weighted average rate. For PP&E, here we've used the year-end rate, but here we've used historical rate for PP&E when PP&E was purchased. So that's the difference between the differences in the balance sheet numbers when you're translating and remeasuring. So now the total of your asset side in case of remeasurement comes to 75,492. So we've looked at assets. Now let's look at liabilities. Accounts payable, debt, both of these are fixed dollars. Both of them are monetary. We're going to use the year-end rate for both of them. Year-end rate 11 cents, 40,800 into 11 cents gives me 4,488. And we have long-term debt 158,400 local currency unit into year-end rate 11 cents gives me 17,424. Totally at 21,912. Stockholders equity. Now stockholders equity, that's a non-monetary item. So we're going to use the historical rate for that. Non-monetary. Guys, in case of translation, we didn't care about monetary, non-monetary. Here, remeasurement, we really need to look into whether it's monetary or it's non-monetary. So common stock, that's 240,000 local currency unit, non-monetary, use the historical rate, 17 cents. So 240,000 local currency into 17 cents gives me 40,800. Now guys, remember our asset side of the balance sheet, that needs to tie in with the liabilities plus equity side. Now in case of translation, we had a plug to accumulated OCI because the gains and losses on currency translation goes into accumulated OCI. That's the C of our pace. But the gains and losses on remeasurement, they would go to the income statement. So the plug here would be retained earnings. So retained earnings would have a number such that the asset side is equal to the liabilities plus equity side. So here we have 75,492. $75,492. Now from this, let me subtract 21,912 liabilities. So the equity needs to be 53,580, of which we have $40,800 on common stock. So minus 40,800. So retained earnings, it needs to be 12,780. So that's the plug number. So guys, we've started with the balance sheet here in case of remeasurement. We've gotten the plug for retained earnings. Now we'll take this plug up here. Guys, look at the direction here. We're going from the balance sheet towards the income statement. So we're going to take this plug here, put it here. Or rather, let me use the black pen for this so that it's more visible. 12,780. So this flowed in here. Now beginning retained earnings was 0, Difference was 0. To make it simple, so the net income for the period, that needs to be 12,780. So this is your plug 2. So this was plug number 1. Now this was a simple calculation because you had no beginning retained earnings and no difference. So this becomes plug 2. And this number now flows here. Look at the way, look at the direction, guys. Interesting, right? So this is 12,780 net income here. Now, we had used weighted average exchange rate for translating income statement items. We're going to use the same weighted average exchange rate to remeasure income statement items. But you just need to be careful with depreciation or items related to the balance sheet, non-monetary items. So depreciation, that relates to PP&E, a non-monetary item on your balance sheet. So for depreciation, we're going to use the historical rate. Otherwise, it's all weighted average. So a little exceptions with remeasurement. It's not so plain vanilla, but we're getting comfortable with this. So sales weighted average. So you have sales of 630,000 local currency unit, which is going to be multiplied by 14 cents, the weighted average. Let me write it here. I've touched it too often. Yeah. So the weighted average rate, 14 cents, 630,000 local currency unit into 14 cents gives me 88,200, same number as we have there. COGS is 67,200. Again, we're using the weighted average. For depreciation, we're going to use historical rate. So 26,400 multiplied by 17, not 14, 17 cents historical rate. For other items, we've used weighted average. For depreciation, because it relates to a non-monetary asset, PP&E, we're going to use historical, and this comes to 4,488. SG&A use weighted average, so 50,400 local currency unit into 14 cents. That gives you 7,056. Operating income is $9,456. Now the income tax expense 22,800. That again needs to be weighted average, 14 cents. That calculates to 3,192. Now guys, I told you, gains and losses from remeasurement, that would come onto your income statement as a non-operating item. So now this becomes your X, this becomes your plug 3. You got to find out what's the number here that would make your income statement tally. So we have 9,456 of operating income. We have 3,192 of taxes. And net income number, we know the answer, 12,780. So now guys, simple algebra here. What we'll do is, we'll start with 12,780. We'll subtract 9,456. Remember the math. So this plus X minus this equals this. So this goes on the other side, minus 9,456. And we're going to do plus 3,192. And that gives us $6,516 here. If you've forgotten maths from school, don't worry. You found out an answer, a plug answer, check it. So that's a simple way I do it. So what I do is, after I have the plug, I'll do a recalculation. I'll do, is 9,456 plus 6,516 non-operating item minus 3,192 taxes, is that equal to 12,780? Yes, it is. So guys, we're good to go. So guys, we started from the balance sheet. We had a plug here for retained earnings. We took that to the statement of retained earnings. We found out the plug for net income. And using that plug, we found out the remeasurement gain or loss. So here we've had a remeasurement gain of $6,516. There we had a translation loss. Translation loss, accumulated OCI. Remeasurement gain or loss on your income statement non-operating item. So guys, that is all about foreign currency. Remeasurement and translation when you have a related foreign subsidiary. So guys, for remeasurement, quick recap. We remeasure when the functional currency is US dollars. So we're moving from transactional currency to the functional currency. Transactional currency, that's the local currency unit. Functional currency, US dollar, remeasure. Remeasurement, your direction is balance sheet to your income statement. Why? Because your plug, your remeasurement gains and losses, that's on your income statement. Now, when you're doing your remeasurement for balance sheet items, remember, if it's a monetary item, use the year-end exchange rate. If it's non-monetary, use historical rate. On your income statement, generally, you're going to use the weighted average rate, same as what you did here, except for items like depreciation, where you have to use the historical rate. So guys, that is about remeasurement versus translation. Now, I'll give you a quick mnemonic here for you to understand and remember this. So you could say when you're doing remeasurement, you're moving from the balance sheet to the income statement. When you're doing translation, you're moving from the income statement to the balance sheet. So now I've tried to do a mnemonic here, and I would say we're talking about RBI. Now, RBI stands for the Reserve Bank of India. So RBI in Tibet, TIB. So guys, that's your mnemonic. When you're doing remeasurement, balance sheet to income statement, RBI. When you're doing translation, income statement to balance sheet, Tibet. So we're looking at RBI in Tibet. And if you remember this, you know all about remeasurement versus translation. On page 29, we got steps for highlight remeasurement and highlight balance sheet to income statement. So for remeasurement, our direction of movement is from the balance sheet towards the income statement. And a mnemonic to remember this is RBI. For remeasurement, move from balance sheet to the income statement. Let's look at the remeasurement approach towards the bottom of this page. So we're starting with balance sheet. Now under assets and liabilities for non-monetary items, so underline non-monetary for assets and highlight at H. Use historical exchange rate. Same rule for liabilities. So underline non-monetary and highlight at H. Historical exchange rate. But for monetary assets and liabilities, we're going to use the year-end exchange rate. So under assets, underline monetary, highlight at Y. Under liabilities again, underline monetary and highlight at Y. For equity contributed capital, we're going to use the historical exchange rate because that's non-monetary. So highlight at H. So this would get us to a retained earnings plug which flows as ending retained earnings to the statement of retained earnings. Then we have a second plug, net income, which then flows to the income statement and helps us calculate the non-operating gain or loss from remeasurement. Now on the income statement, we're going to use highlight at W, weighted average rate, to remeasure income statement items. Now if the income statement item is balance sheet related, something like depreciation, then we're going to use highlight H if balance sheet related, historical exchange rate. Turn to page 30. We've already looked at translation where we're moving from the income statement to the balance sheet. Let's just put a mnemonic here, right? TIB and ET. So guys, we're looking at RBI in Tibet, remeasurement, balance sheet to income statement. Translation, move from the income statement to the balance sheet. Getting back to page 32, we are again looking at an example, but this time for highlight remeasurement. So we are remeasuring local currency unit to underline dollars and put a dollar sign there. Now remeasurement is RBI. That means we're moving from the balance sheet to the income statement. So let's first look at the balance sheet here. Now on the balance sheet, we're going to use the year-end exchange rate of 11 cents for monetary items and the historical exchange rate of 17 cents for non-monetary items. So right there, monetary equals Y, non-monetary equals H. Now inventory, even that's a non-monetary asset, but it's given that inventory was purchased during the year. So we've used the weighted average rate of 14 cents to remeasure inventory. Now the remeasurement of the balance sheet items, that has led to highlight plug number 1, $12,780 of retained earnings. Now that flows upwards to the statement of retained earnings, which gives us highlight plug 2, net income, that's again 12,780. Now the net income number flows through to the income statement. Now we have remeasured income statement items using the weighted average rate. So put a box around 14 cents for sales and COGS, 14 cents for SG&A and 14 cents for income tax expense, write W. We've used 17 cents for depreciation expense because that's related to a balance sheet item, PP&E. Now after remeasuring all the income statement items using the net income of 12,780 that's flown in from the statement of retained earnings, we calculate our highlight plug 3, which is $6,516. So that's the gain on remeasurement, which comes as non-operating income on the income statement. Now on the bottom of the column for remeasurement, write balance sheet to income statement and write gain or loss in income statement. So the gain or loss on remeasurement, that's on the income statement, and that's the reason we are moving from balance sheet to income statement. In case of translation, we had moved from income statement to balance sheet because the gain or loss on currency translation, that was on the balance sheet, accumulated OCI. Guys, I simply love this structure of getting from the transactional currency to the reporting currency because this helps you decide whether you need to remeasure or translate. So if you have two different local currency units, remember the Sri Lankan subsidiary which had the transactional currency Lankan rupee, but it bought all the goods from the Indian subsidiary where the functional currency was the Indian rupee. The reporting currency for Ford, naturally that's the US dollar. So in this case, you first need to remeasure, then translate. But if we are just looking at one local currency unit, just one foreign currency, then if the functional currency is the US dollar, then you just need to remeasure. Guys, remeasurement, remember RBI. So in remeasurement, you move from the balance sheet to the income statement because the gains and losses on currency remeasurement, they went to the income statement. Now, when we are looking at functional currency being the local currency, in that case, this is the same. You need to translate to get to US dollars on the consolidated financial statements. So guys, translation, that was Tibet. So this was RBI and now we're looking at Tibet. So TIB. So here you're moving from the income statement to the balance sheet because it's on your balance sheet that you park the gains and losses on currency translation. Remember, accumulated OCI and the C of your pace. So C of your pace, this stands for currency translation gains and losses. So guys, now you're experts on whether you need to do remeasurement or translation. So now we've been talking all about GAAP. IFRS also has the same rules for foreign currency when you're looking at the foreign subsidiary. But it's got a little different terminology, different vocabulary. So they say, instead of calling it transactional currency, IFRS would call this foreign currency. Doesn't make a difference, does it? Functional currency, same terminology, GAAP and IFRS. Now IFRS, instead of calling it reporting currency, they call it presentation currency. On page 31, we're looking at IFRS terminology. So circle IFRS. Now transaction currency is termed highlight foreign currency. Next highlight functional currency, which is termed similarly. Reporting currency under IFRS is called highlight presentation currency. So under GAAP, we got transaction currency, functional currency and reporting currency. Under IFRS, we got foreign currency, functional currency and presentation currency. We've looked at foreign currency accounting in case of a foreign subsidiary, a related company. Now let's talk about standalone foreign transactions with unrelated companies abroad. So now we're looking at foreign transaction with an unrelated company. Now here you could have an operating transaction or it could be a forward exchange contract. Now, operating transaction is when you're buying, selling, lending or investing in a foreign country. And for such operating transactions, we will use the spot rate of foreign currency exchange. So we'll use spot rate. Now to understand foreign transactions for operations, we'll look at an example that we have on a book. So it says example on foreign currency operating transaction. Export Inc. made a credit sale on 22nd December 2010 to import company for 1000 LCU. So a US company has made an export for 1000 local currency units. So they'll be receiving the proceeds in the foreign currency. And they collected the receivables next year on 20th Jan 2011. The value of 1 LCU in terms of the dollar was, so they got spot rates on 22nd December, 31st December and the date of collection 20th January. So let's look at this. Now this is a sale transaction at 1000 local currency units and you got the spot rates on 22nd December 2010. The spot rate was 1 LCU equals 65 cents. So 1000 LCU, that's $650 of sale on this date. Then you have the spot rate as of year end 31st December. At that point, 1 local currency unit was 75 cents. Then you have 20th Jan 2011, 1 LCU equals 80 cents. So basically the local currency unit has appreciated. So let's look at how does it impact our income statement. So on 22nd December, when the sale was made, the journal entry would be accounts receivable to sales. Now the receivables, that's in the local currency unit, the foreign currency, We cannot have that on our books because our books is all in dollars. We'll convert this local currency unit 1000 LCU into dollars as of the date of sale, and for that we're going to use the spot rate 65 cents. So instead of saying that we've made a sale of 1000 local currency units, the foreign currency, we would say we've made a sale of 1000 into 65 cents, $650. So that's the sale number which goes into our income statement. Then at year end, 31st December, we will look at this again. We will look at our receivables of $650. Is that receivable still worth $650? Let's look at spot rates. At 31st December, that receivable is worth more than $650. It's now worth $750. Guys, we've had a foreign exchange gain. We're not going to touch a sales number for that. What we will do is we'll actually increase receivables, because receivables on the balance sheet, they're not 650, they are 750, 650 plus 100. The credit now would be to gain on foreign exchange. So this is a gain on foreign exchange of $100. This one also goes into the income statement. So sales, that was an operating item on our income statement. On-tide no C, so this is the O. Foreign exchange gain, that's a non-operating item, N of our on-tide. So you have sales and gain both going to our income statement. So receivables, they were $650 at the date of sale. At year end, they've become $750. Then the collection actually happened on 20th Jan. Now, when we went out to collect the foreign currency 1000 LCU on 20th Jan, we would look at the spot rate then. Now, spot rate then was 80 cents. So that means we would be getting $800, not 750, 800. Another gain of $50. So we're going to have a gain, accounts receivable to gain again, foreign exchange gain of $50. This gain again goes into our income statement. Guys, the receivables, they were $650 on the date of sale. Then we had a gain at year end, became $750. Further gain when we went out to collect the cash became $800. Now we're going to collect the cash. So it'll be cash coming in and accounts receivable credit. So that'll be $800 of cash coming in. The focus here, what we're looking at is the gains on foreign exchange. These gains, these are non-operating items which flow into your income statement. On page 33, we're looking at individual foreign currency transactions. So right there, unrelated company equals foreign transaction. First, let's talk about operating transactions. So put a box around operating transactions and highlight buying, selling, lending or investing in a foreign country. On the left, right, use spot rate. Turn to page 34 where we are looking at an example. Put a box around operating transaction. Now this example talks about Export Inc. making a credit sale on 22nd December for 1000 local currency unit and the receivable being collected on 20th of January next year. Now we are looking at highlight spot rate. On 22nd December it was 65 cents. On 31st December that was 75 cents. So draw a bracket and write year end gain. On 20th Jan next year, when the receivable was actually collected, then the spot rate was 80 cents. So draw another bracket and write transaction closing date gain. So the year end gain, 1000 LCU into 10 cents, $100. So highlight gain and write I/S because that $100 goes to your income statement. On the date of realization of the receivable, there was an additional $50 of gain. So highlight gain, and for $50 write I/S, because even that goes to your income statement. So the gains and losses from foreign transactions, they flow into the income statement. Now let's talk about forward exchange contract. I'm sure you remember forwards from derivatives in FAR-3. Now we're looking at forwards for foreign currency. So this is an agreement to exchange two different currencies at a future date at a specified rate agreed upon today. So the exchange is happening in the future. Rate agreed upon. Now to understand whether there's been a gain or a loss on this forward exchange contract, we're going to use the forward rate because the exchange is going to happen in the future, forward. Now, as for derivative contracts, a forward exchange contract for foreign currency could happen due to two reasons. Number one, speculation. We're trying to profit from market fluctuations, or it could be hedging. And for hedging, we could have a fair value hedge or a cash flow hedge. And let's look at all this on the other side of my board. We're looking at a forward exchange transaction. Purpose could be speculation or a fair value hedge or a cash flow hedge. Now speculation, as I told you, you're trying to profit from market fluctuations. It's like betting. Now fair value hedge is when the foreign currency related asset, liability or commitment exists right now. And you're trying to hedge because you don't want to lose on that asset, liability or commitment. So guys, here let's say you own imported inventory. So you've purchased inventory from abroad, imported it, you got to pay your suppliers in the foreign currency. You don't want to lose because of foreign currency fluctuations, so you want to enter into a hedge because of that. That's a fair value hedge. But let's say you don't own any inventory yet. You plan to go out and import inventory. And you're worried that you might lose money because of the foreign exchange fluctuations. Want to enter into a hedge because of that. That's a cash flow hedge. Here you plan to import inventory. So in case of speculation, the gains and losses that you have from this forward exchange contract, from this derivative, that goes into your income statement. Fair value hedge, again, the gains and losses from this hedge, they go into the income statement because that's the purpose of the hedge. You don't want to, if you lose money here, you should gain on the derivative. If you gain money there, naturally you're going to lose money on this derivative. So it's income statement, whether it's speculation or fair value hedge. But when it's a cash flow hedge, when it's a future forecasted foreign exchange transaction, you don't want to take the gains and losses from the derivative to your income statement yet. You want to wait till that transaction actually happens before you get the gains and losses to your income statement. So for now, what you'll do is you'll park your gains and losses from the cash flow hedge on your balance sheet. And the place that you park it is in accumulated OCI. And this is the E of your PACE, effective portion of cash flow hedges. And let's understand forward exchange contracts in detail by looking at an example that we have on a book. So Forward Inc. is entering into a 90-day forward exchange contract to acquire 100,000 British pounds in exchange for US dollars. Now the contract is being formed on 1st December 2010, will be settled on 1st March 2011, 90 days later. So you got the exchange rate into pounds. So you have this contract which happens on 1st December 2010. And this is a 90-day forward contract. So as per this contract, the two parties, they're going to exchange pounds for dollars. So when we're looking at our company, the US company, they're going to receive 100,000 British pounds and they're going to pay $170,000. Because as per the 90-day forward rate, the British pound is going to be worth $1.70 on 1st of March, 90 days later. So this 100,000 pounds that they're going to receive, it's going to be worth $170,000. And that's why they'll pay $170,000. So this is going to be worth $170,000. Now, on 31st December, when they look at this contract again, on 1st December, there were 90 days for the contract to be settled. So we looked at the 90-day forward rate. On 31st December, it's just 60 more days. So now we're going to look at the 60-day forward rate. Now the 60-day forward rate for pounds, that's $1.78 on 31st December 2010. So here it was $1.70. We're looking at the 90-day forward rate. Here we look at the 60-day forward rate. Because now only 60 days are left for the contract to be settled. There's a 30-day gap between 1st December and 31st December. So 60-day forward rate is $1.78. So guys, they are still going to receive this 100,000 pounds. But this 100,000 pounds now is worth more than $170,000. It's going to be worth $178,000. How much are they going to pay? They're going to pay $170,000. So guys, receive something worth 178. Pay out only 170. That's an $8,000 gain. Once again. So as per the contract, they're going to be receiving 100,000 British pounds 90 days later on 1st March. And they're going to be paying $170,000 for these 100,000 pounds. Now the exchange rates have changed in 30 days. Now the forward rate looks like these 100,000 pounds which they're going to receive on 1st March, they're going to be worth $178,000. But how much would they pay? They would pay $170,000 for that. So they're going to receive still 100,000 British pounds which are now worth 178 and pay 170 for that. That means they're going to have a $8,000 gain on this derivative. So that is $8,000 gain. Now the question is, how do we record that gain? Now that depends on whether it's a speculative transaction or it's a hedge. Now if it's a speculative transaction, so let me just create some space here. So if it's a speculative transaction, on 31st December, they're going to record a receivable on this derivative and they have a gain of $8,000. Because derivatives, there'll be a net settlement. So you could say they have a receivable of $178,000, payable worth $170. That's a gain of $8,000 which goes to the income statement. Now, if it's a fair value hedge, there's more to it. There's a transaction which has happened along with this forward exchange contract. So we're looking at two things. We're looking at number one, an operating transaction, and number two, a forward exchange contract. So let's read. It says, Forward Inc. has purchased inventory on 1st December 2010 and received an invoice for £100,000 with payment terms of net 30 days, net 90 days. So here, on 1st December 2010, they bought an inventory. So for inventory, they have accounts payable which is to be paid in 90 days. Now for operating transaction here, we're going to use spot rate. So what's the spot rate on 1st December? The spot rate is $1.65. So this is going to be recorded at $165,000. Now on 31st December, again, we look at the spot rate to check if the accounts payable is still worth $165,000 or something else. So the spot rate on 31st December 2010 is $1.75. So guys, this accounts payable which is on the books at $165,000 is now $175,000 because they're going to be paying out 100,000 pounds. Spot rate $1.75. So this needs to grow up by $10,000. Naturally, this is a loss because we got to pay more to the vendor. So this loss of $10,000, this goes into the income statement. Now this one here, this is an operating transaction, something what we saw here. So we had an operating transaction. So in this case, we had a receivables. At year end, we checked what's the current value, spot rate for the receivable, and we had a gain or loss. So similar thing happening here. So on 31st December, we are looking at what's the payable as per the spot rate. So this one is an operating transaction. Now, along with this, we're going to have a forward exchange contract, which they have entered into for hedging purposes. Now, as per the forward exchange contract, they had a gain of $8,000. So, as per that contract, they're going to have a receivable, a net receivable of $8,000, gain of $8,000. So, in this case, speculation, there was only the forward exchange contract. Here, it's an operating transaction plus a forward exchange contract. So they've lost money on the operating transaction. It's a loss which has gone to the income statement. Now the purpose of the hedge was to mitigate, to avoid this loss. And that's why they had a gain here, which again goes to the income statement. So if they didn't have this forward exchange contract, they would have a $10,000 loss which would have gone to the income statement. But because they were smart, they entered into this fair value hedge, $10,000 less $8,000 gain, only $2,000 of loss went to the income statement. So guys, that's a fair value hedge when you already, let's say, own important inventory in this case, and the gain or loss on the derivative on the forward exchange contract would flow into the income statement. So that mitigates the loss on this inventory. Now, if they had a gain on this operating transaction, they would have had a loss on the hedge. So it runs the other way. Now, looking at cash flow. So it says Forward Inc. plans to purchase inventory from a British supplier or invest in the foreign securities of a British company. So they have a plan to do something with pounds in the future. That's why they want pounds 90 days later. They got a plan to do something. They've only planned yet. It's not yet done. So now in that case, there is no operating transaction. It's only a forward exchange contract. So on 31st December, they're going to have a gain on this forward exchange contract. So let's put it here. So under cash flow hedge on 31st December 2010, they're going to have a receivable and a gain of $8,000. This gain, this goes into accumulated OCI on the balance sheet. So when they actually go ahead with the transaction that they plan, they forecast, then we would take it out from the balance sheet, put it on the income statement. For now, we're going to park it on the balance sheet. So guys, as you can understand, for speculation, fair value hedge or cash flow hedge, the forward exchange contract journal entry, this one, and this one, So this one was the forward exchange contract. They are pretty similar. The difference is, in both these cases, the gains, they've gone to the income statement. Here, the gains, they have gone into the balance sheet, parked in accumulated OCI. Now, for a fair value hedge, along with this forward exchange contract, you also have an operating transaction. So with this, we've also summarized how an operating transaction looks, where you actually have a transaction. You've bought goods, you've sold goods, you've invested, you've borrowed money. So that's an operating transaction. And here we have forward exchange contract, the journal entries that we learned when we did derivatives in FAR-3. Now let's look at it on the book, and with this we are done with foreign currency. Back on page 33, we're looking at, put a box around forward exchange contracts. Highlight agreement to exchange two different currencies at a future date at a specific rate. On the left, right, use forward rate. Now you could enter into a forward exchange contract for speculative purposes or for hedging. So under speculation, right, betting, because that's a very good example of speculation, where you speculate in the foreign currency in an attempt to profit from changes in valuation. Gains or losses, they go to the income statement. Now for fair value hedge, the purpose is to avoid losses on changes in an existing foreign currency related asset, liability or commitment. The gains or losses, they go to highlight income from continuing operations on income statement. Now this is because the receivable or the payable or the commitment highlight exists now. And below this column, right, own imported inventory. And that sounds like, right, operating transaction plus forward exchange contract. So there's an operating transaction plus this forward exchange contract, where the purpose is to hedge, to avoid any possible losses. Last column, we're looking at cash flow hedge, where the purpose is to avoid losses on changes in a planned future foreign currency related transaction. Gains or losses, they go to highlight OCI pace in the balance sheet and highlight nothing in income statement until the transaction actually occurs. And below the column, right, plan to import inventory. So in our example, we're saying, you don't have the inventory yet, you plan to import inventory and you want to avoid losses on this planned future foreign currency related transaction. Turn to page 34, and here we are looking at an example of foreign currency forward exchange contract. So put a box around forward exchange contract. And here we have Forward Inc. entering into a 90-day forward exchange contract to acquire 100,000 British pounds in exchange for US dollars. The contract is being underlined formed on 1st December 2010 and will be underlined settled on 1st March 2011. We've got the exchange rates for 1st December and 31st December. Now on 1st December, we're going to use the 90-day forward rate. So highlight $1.70 and write 90 days as of 1st December 2010. Now on 31st December, we're going to use a 60-day forward rate. So highlight $1.78 and write 60 days as of 31st December 2010. Looking at the first part of the solution, right there, speculation. On 1st December, when the contract is being formed, we're going to use, right, forward rate. On 31st December 2010, highlight gain of 8 cents per pound due to the increase in value of the pound. And again, we're looking at, right, forward rate. So on 1st December, we looked at the 90-day forward rate. On 31st December, we're looking at the 60-day forward rate. And on the credit side, highlight gain, and the $8,000 gain that goes into I/S income statement. Move to page 35. And the second part of the solution, write fair value hedge, and that's equal to operating transaction plus forward exchange contract. Now on 1st December, for the operating transaction of purchase of inventory, we're going to use spot rate. That's $1.65. But for the forward exchange contract on the same date, we're going to use forward rate. Then at year end, to understand the gain or loss on the operating transaction, we again are going to use spot rate. And we saw here that there is highlight loss, and for $10,000 write I/S, because this loss on the operating transaction, this goes into the income statement. Again, on 31st December, to understand the gain or loss on the forward exchange contract, we're going to use forward rate. And we saw that we had a gain on the forward exchange contract. So highlight gain, and the $8,000 gain that went into I/S income statement. Moving down on this page and looking at the third part of the solution, write cash flow hedge. So on 1st December, when we entered into the forward exchange contract, we're going to use forward rate. Again on 31st December, to understand the gain or loss on this cash flow hedge, we're going to use forward rate. And we saw that there was a gain on this forward exchange contract. Now this gain goes into highlight accumulated OCI. And write the PACE, PACE, circle the E, because E stands for effective portion of cash flow hedges. For the $8,000 gain, write B/S, because accumulated OCI, that's a balance sheet account. Make a note on the bottom of this page, right? Cash flow hedge means remember to park gain or loss in accumulated OCI now. And reclassify to income statement when planned transaction actually happens.